People have been talking about the coming real estate crash in Canada for years. First, it was the pandemic in 2020. Next, it was the rising prices in 2021. And then it was the rising interest rates, housing bubble, and home prices in 2022, 2023, and 2024. And now the latest excuse is the upcoming mortgage renewals that Canadians will face in 2025 and 2026. And look, I definitely get it. About 60% of Canadian homeowners are going to have a mortgage renewal between now and the end of 2026. Most of them will see interest rates that will double or even as much as almost triple in some cases, which means skyrocketing costs for these homeowners. But does this mean a wave of foreclosures, panic selling, and plummeting price points, or is this fear just completely overblown? I'm going to dive into that in a minute, but just before I do, if you're new here, my name is Andrew Stevens. I've been a realtor in Halifax for 10 years, and if you want to be educated on the Canadian, Halifax, and Nova Scotia housing markets, then you're in the right place. So hit that like button and hit that subscribe button. And if you're thinking about making a move in the Halifax and surrounding area and you'd like to get in touch with me to help you with that, you can reach out to me anytime in the Calendly link below. So here's the problem. About 60% of Canadian homeowners are going to see a renewal in between now and the end of 2026. Now, most of these people have bought homes in 2020 and 2021 at very low interest rates compared to what we're seeing right now. So back then they would have had a mortgage interest rate of about 2 to 2.5%. And now if they were renewing today, it would be about 4 to 4.5% if they do select another 5-year fixed rate. And these changes could mean significant monthly cost increases to these homeowners. Anywhere in the realm of $500 to $1,000 a month is certainly possible, or even more in certain cases where people have large mortgages. And I can tell you, I personally just went through this, so this is a hot topic for me. And my personal mortgage increased by about $650 or $700 a month. So yes, it does hit hard, especially if you bought kind of at the right time and you had a really low mortgage payment. But this is sort of the reality going forward. And then if you multiply this by millions of Canadian homeowners facing this problem, you can obviously see that this could be a potential problem coming down the pipeline. But the question is, are people financially prepared for this? So in some cases, some people may be working in jobs, especially young professionals that climb the corporate ladder. They may be working in jobs so they're making more money today and they've already adjusted their finances accordingly. Or maybe some people were already feeling the pinch from the inflation that we've been seeing in Canada, and maybe they've already adjusted their finances and they're foreseeing this coming. But yes, there will obviously be some people that are not braced for the reality of what is about to hit them. But here's the key. Just because mortgage payments increase even by a significant amount like this does not mean that people are just going to automatically sell their home. And the idea that millions of homeowners are about to flood the market with their homes and that's going to crash the market is simply not accurate. Now in this video, I'm going to break down 5 big reasons why this is not going to crash the Canadian real estate market. And yes, I'm sure there's a bunch of people in the comments waiting to drop in there and tell me why it's going to crash the market, but here's 5 reasons why that's not going to happen. So first off, I believe people will do pretty much anything to stay in their home if that is what they want to do. Let's face it, there's not a lot of cheaper options out there. If you're somebody that bought in 2020 or 2021 in Halifax, for example, and let's say you paid $350,000 or $400,000, now if you're looking to sell that home and go somewhere else, well, if you sell it and go to rent, that's not really cheaper based on the rental market. If you sell your home and look to buy another one, well, the other home you're going to buy is going to be priced a lot higher than the current home that you have based on kind of what you bought back in 2020 versus what that particular house will be worth today. And you're facing the high interest rates, which again is basically the same problem. And even if you're considering downsizing to a smaller home, those smaller homes that were worth $350 back in 2020 are now worth $500 today. So even if you have a lot of equity built up, you're still buying a home that is not really going to work for you financially if that current home that you bought in 2020 or 2021 for that kind of price range is not going to work at today's renewal as well. Which leads me into my second point, that the banks are going to work with homeowners to restructure their mortgages to help them stay into houses. Now, whether or not this is the right decision for you is a whole different story. I don't believe that the bank is your friend, but in this case, they are looking to work with people and help them restructure, and there's been some rule changes that are going to help with this as well. So some things that people could do would be like push their amortization out, so extend their amortization to help relieve that payment shock at that higher interest rate. And now I'm not saying this is about helping people. This is about protecting the bank and their bottom line. They don't want to deal with all kinds of foreclosures either. And most of these homeowners have a ton of equity in their property as well, which will allow them to work with the bank to restructure debts and so on, which is my third point. These homeowners facing these renewals in general, especially in Halifax at least, are going to have a ton of equity built up in their property. And when I say a big amount of equity, I really mean it. If you bought a home in 2020 at the average sale price, right now it's worth approximately about $230,000 more now than it was back in 2020. And if you bought a home at the average sale price in 2021, it's still worth about $135,000 more today than it was in 2021, plus the amount that you would have had paid down in your mortgage in that first 5-year period. So these homeowners are sitting on a ton of equity, and that is a huge factor here, because the reality is if these people are struggling and they're going to struggle to pay their mortgage payment, they're probably debt serviced very high in other areas as well. Maybe they have lines of credit, maybe they have credit cards racked up, whatever that may be. And I think the bank is going to work with a lot of these people to help them restructure their debt to consolidate by doing a home equity line of credit and things like that. I think there's a lot of things the bank could do to get creative when somebody has that much equity in their home that's going to allow them to restructure, consolidate debts, and stay in their home if that is what they would like to do. And for the record, because I know some people are thinking it right now, but what about those people that bought at the peak of the market in 2022? Let's say spring 2022, as far as the Halifax market goes. Well, I'm here to tell you that the market has gone down and rebounded since then. And right now across the HRM, the average sale price is actually higher now than it was at the peak of the market in 2022. So if those people made it to this point in time, they're going to be looking pretty safe as well, even if they're only looking to renew 4 years after their initial purchase in the spring of 2026. There's also two aspects of the overall government mortgage regulations that are very much going to help people stay in their properties. Now, the first one, which is my fourth point, is the mortgage stress test. Remember when everybody hated when this was brought in back in 2016 and thought it was ridiculous? Well, I'm here to tell you that this may have saved the ass of a lot of homeowners, especially with these renewals coming up in 2025 and in 2026. So the stress test was in place, and all these people who got mortgages, even in the very low interest rates of, let's say, 2% or even lower, that means they're getting stress tested at a minimum of 5.25%. So in theory, yes, these people can afford, as far as the bank is concerned, they can afford their mortgage payment if they were at a 5.25% mortgage rate, and most of them will be renewing somewhere around the 4 to 4.5% range as of right now anyway, and maybe that comes a little bit lower with time as well. So even though they're going to see a big sticker shock on their mortgage, they're actually paying less than the amount that they were qualified for when they purchased their home back in 2020 or 2021. And the fifth and final point is something that was just brought into place in the last year, and that is that if you're renewing a mortgage and staying with your current lender, you do not need to requalify for your mortgage. And in my opinion, this is a huge regulation change that happened, and it is a very good one as far as I'm concerned. That means that no income verification is required. That means that no proof of affordability at today's rates is required. You could just sign and continue on. Now, this could be a huge factor in keeping people in their homes, and I'm not suggesting that you should just click that renewal as you get it, but if you're somebody struggling, that might be the best option for you. But I can tell you that if you're not struggling, it may be the best option for you to not sign that renewal and to contact your broker or your bank to restructure or to move your mortgage to another lender, and that may save you a lot of dollars down the road, as that's what I did with my mortgage when it was up, and it did save me a few $100s a month just by moving it to another lender. And by the way, I know people say, oh, I want to stay at my bank and all these things, but guess what? The bank is not your friend. You don't owe them anything, and that payment comes out of your account just like any other payment does, whether it's a Good Life payment or a cell phone payment or anything like that. So it doesn't really matter where your mortgage is at, but the terms do matter. So you should be talking to a mortgage broker if you're up for renewal in 2025 or 2026 before just auto-clicking what the bank sends you via email or via a letter in the mail. So will these mortgage renewals actually lead to a crash in the housing market in Canada, or is this just another media-driven, overblown fear that is not actually going to play out? Don't get me wrong. Yes, there are some homeowners that will struggle. Yes, there are some homeowners who may lose their house. Yes, there are some homeowners who may sell because it's the best option for them. But are we likely to see a flood of listings hitting the market and that's going to crash and have all these downward pressure on pricing? To be honest, I believe it is highly unlikely. With banks banks restructuring mortgage terms, with the amounts of equity that homeowners are sitting on, and with interest rates already stabilizing, the market is far more resilient than you think it is. But I'm curious to hear from you in the comments below. Do you think the mortgage renewals are going to have a significant impact on the housing market here in Halifax and across Canada? I'd love to hear what you think in the comments below. And before I go, if you get any value out of this video, all I ask is that you hit that like button and hit that subscribe button so you don't miss any of my future content. That'll help push this out to more people like you who may be interested in viewing videos about the real estate market. And until next time, thank you so much for watching. I really appreciate your support and have a great day.